Okay, now we'll go to a couple of what I'll call, again, special issues with regard to foreign-based company sales income. The first point is that if you look back to the general definition of foreign-based company sales income, it's property which is purchased and sold, and there's a related party involved, and the points of origination and destination are outside the country of incorporation. Okay, that's your basic rule. But what if the foreign corporation, does more than just buy and sell? Well, the concept is if it does more than just buy and sell, well, maybe it's not, shouldn't be, foreign-based company sales income. And where do you reach that threshold that the CFC has done enough to eliminate this subpart F taint from the income? So we're defining that threshold. Now there's three rules that you find. And one of those rules is, do you have something that is a substantial transformation? Does it look like, does it look like whatever the CFC bought has been transformed into something else? So, three obvious examples. You transform wood pulp into paper, or steel rods into nuts and bolts, or you take a tuna off a fish and put it in a can. In all of those cases, if you looked at the item before and after, they're different. That something's really happened. So this is sort of a qualitative test, and you know it when you see it. The second test is maybe a little bit more of a quantitative test because there's a safe harbor. And that safe harbor essentially is that if you've done enough work such that there's been conversion costs, which is direct labor and factory overhead, which is more than 20% of the cost of goods sold, then that'll be deemed to be enough activity and you'll meet the threshold. Now, there is a third test which is of relatively recent vintage. And this is particularly interesting because this is a reflection of the, let's say, the U.S. Treasury and the IRS realizing that conditions have changed. If we go back, let's say, 15, 20 years, even 10 years, a great percentage of the goods manufactured in foreign countries by U.S. multinationals, U.S.-based multinationals, manufacturing was done by subsidiaries within those multinational groups. They would set up a company, they would buy a plant or lease industrial facilities, and they would hire employees, and they would do the manufacturing themselves. But especially with the rise of China in the late, let's say mid to late 90s, there started to become more and more often contract manufacturing arrangements where the multinational no longer owned, albeit indirectly through a subsidiary, but the multinational no longer owned the plant and the equipment and the inventory necessarily during the processing. They arranged for others to use their technology and create a new, create whatever the product was, manufacture the product. So this was typically called contract manufacturing. Well, as you can imagine, if we have a rule that foreign-based company sales income is outside the country of incorporation, point of origination, point of destination, outside the country of incorporation, and you have to manufacture it yourself. I think one of the earlier slides that I didn't necessarily focus on was that the activity has to be conducted by the CFC's employees, cannot be independent contractors. So there's been this change in the market, so to speak. Over the last 15 years, there's been a very, very significant increase in the amount of contract manufacturing done. So you had a lot of companies that are saying, well, wait a minute, the contract manufacturer is only following our orders. It's still our employees who are giving direction, telling them what to do. It's still our intangible, which is allowing them to be able to manufacture whatever the product is. They're doing it under our direction. They're doing it at our request. It's at our economic risk. We're only paying them, in a sense, a cost-plus percentage. They're not taking business risk of owning inventory and whether or not there's a market out there for the items to be sold. If the U.S.-based multinational is saying, hey, if I'm responsible for all these things and it's only the physical manufacturing of the item and the ownership of the equipment that is in somebody else's hands, shouldn't I still be considered the manufacturer so that I can reach that threshold and not have foreign-based company sales income? So as a result of much pain and suffering over 8 or 10 years, eventually we ended up with changes in the regulations which acknowledge that we have a new paradigm, a new, in a sense, supply chain structure that a lot of multinationals are using. Now, if you're interested in this area, I suggest a couple of things. Number one, I set out in the course fact pattern situation number 7, which is win supply chain structure. There's a relative description of a supply chain structure that makes use of something like this and that is indicative of what happens in the real world. If you're interested further, there's some testimony which I believe I put on the course website from, I think, last July before Congress, where the Joint Committee has put together some descriptions of these kinds of supply chain structures. So again, it's something that is very readable and very worthwhile if you have some interest in this area. This is let's say, a relatively cutting-edge area, supply chain structuring. And what it's meant to do is to avoid, as much as possible, local taxation in the countries where you're actually manufacturing and selling the products, and maximize the amount of income in some central company, which is presumably not subject to tax anywhere, and at the same time do it all within Subpart F so that you do not have Subpart F income. Now, one of my goals, time permitting, is after we've done the transfer pricing discussion in the next week or so, to eventually have a time when what I'm calling is bringing it all together, and to try to talk about this supply chain structure from the standpoint of transfer pricing, Subpart F, reduction of foreign taxes, in order to try to get across something about this area. But if you are interested in want to go into it deeper, there are a lot of things out there, and the couple of things I've mentioned I think would be useful. Yes, Kristen.
So if you set up the companies in the supply chain as disregarded entities, will you not even have to worry about Subpart F?
Absolutely, that's part of it. That's part of it. That can be part of it. Absolutely. By using a disregarded entity, you're eliminating the problem of there being a CFC. But as we'll see in a moment, you might be creating what's called a branch rule problem. And how that works out is very intricate as one tries to create a structure that works. So again, we'll attempt to talk about that during the bringing it all together session. If you look to this, this is what I didn't remember, TD 9438, that has some explanation of both the history of this as well as why they put it in and what it's meant to accomplish. Because these rules are very new. This is from, I think, 2009. Although as, I think, proposed regs or temporary regs, they were here for a while before then, maybe 2 or 3 years. Now let's talk a little bit about the branch rule. Now, the overall concept is, and this is where I was speaking before, that the U.S. rules are not consistent in whether they encourage or discourage tax planning that reduces foreign taxes. Now, let's say, for example, that you have a situation where you have a company in Germany which, let's say, has a 33% rate, and it is manufacturing in Germany. And that German company sets up a Swiss branch, an office in Switzerland. They actually put some employees there. And let's say that as a result of that, under Swiss rules, under German rules, we break up the overall income, let's say, of 200, and 100 is taxed in Germany at a 33% rate, and in Switzerland, 100 is taxed at, let's say, a 10% rate. So we end up with 43 of tax. Germany does not tax the income of the Swiss branch. Local rules in Germany, no tax on the income of the branch in another country. Now, on the surface, this looks like good planning to reduce the level of foreign tax. What the U.S. branch rule does, which is in 954D2, what it does is it says if the use of a branch has the effect that you would have if the branch were a separate company, then you will treat that branch as if it were a separate company and then calculate your subpart F income. So we have to test and see whether the reduction in tax that occurs because of the branch substantially reduces the amount of tax that would be paid if all of the income had been taxed by Germany and all of the activities had taken place in Germany. So we see that if all of it were in Germany, then it would have been a total tax of 66 instead of 43. So this did have the effect of reducing foreign tax, and therefore we have to treat this branch as if it's a separate company. Now, once we say, okay, it's a separate company, now we have a purchase of the product from Germany, which is a separate related party. We have a sale to customers, let's say, outside of Switzerland. And that gives us our definition of foreign-based company sales income. Purchase, point of origination, point of destination outside the country of incorporation, which is Switzerland, and related parties involved. So this creates subpart F income. This, in a sense, is what I was referring to when I was, saying you've got to carefully maneuver your way when you have a disregarded entity. Because a disregarded entity will be treated as a branch, and if that disregarded entity is in another location, another country, then it's the equivalent of a branch, and you have to go through the issues of the branch rule. Now, this involves a case where we have a sales branch. A sales branch. The rules also provide for what's referred to as a manufacturing branch. So we have US, we have, let's say, Ireland, and we have our manufacturing branch in Germany. Okay, now the manufacturing profits are being taxed at 33% in Germany, and let's say 12.5% in Ireland. And again, we have, using the 100-100, we have 12.5 of tax here, 33 here, which gives us 45.5. If all of the income had been taxed in Germany, where the manufacturing is, it would have been 66. So there's been a substantial reduction. So again, now we treat Germany as being a separate company. And we now have Ireland buying from a related party, selling to unrelated parties, and as long as the point of origination, point of destination is outside of Ireland, we have foreign-based company sales income. Now, I'm giving in these examples the most vanilla examples. If you look into the regulations which have been changed relatively recently, making them much worse than they used to be, you find that it can be a morass that is just miserable. What if you have multiple branches? What if you have of the same company 2 manufacturing locations and 3 sales locations? How do you make the test? Which countries do you test to see which whether there's a substantial reduction of tax? So it just gets absolutely miserable. So I would not recommend looking at them unless you have insomnia or you have some masochistic urges. So let's leave it at that. But understand, when there are branches, and we're talking about manufacturing and selling products, even though there is no other related party involved, we can end up with subpart F income because the branch is treated as if it were a separate legal entity, creating that related party involvement. Again, in each of these situations that we've talked about, the Irish company is buying raw materials from third parties, selling its products to third parties. No actual related party involved. But this gives you sort of a deemed related party. And same with this one here. The German company buys all of its raw materials from unrelated parties, sells through the Swiss branch to all unrelated parties. So it creates subpart F income where you say, why are they doing it? But it's there, and it needs to be taken, taken seriously.